Hi, this is the Business Guy. The purpose of this video is to be the most complete video on the internet on how LLCs are taxed, as well as how to file taxes for different types of LLCs, and then how to report your LLC's income on your personal tax returns. I know this can be a bit of a confusing topic, but don't worry, I've been in the business for 32 years and we've filed over 100,000 documents for LLCs, and I'm here to break it down for you step by step. So by the time you're done watching this entire video, you'll understand how LLCs are taxed, which tax forms to file, and which type of LLC taxation to choose so that you can put more money into your pocket. Now first, let's go ahead and start with the basics. An LLC, or a limited liability company, is a type of business that provides its owners or members with limited liability protection. And that means if the business is sued, the personal assets of the members are generally protected. And unlike most corporations, that protection also works from the other side of the company. That is, there are also provisions where when members are sued, the LLC can protect the assets that the LLC holds from personal lawsuits against the LLC members. Okay, now there are 4 ways that LLCs are taxed. So how many ways can LLCs be taxed? 4. So to get the most out of this video, I want you to pay close attention to these 4 ways. Now, when it comes to taxation, by default, LLCs are what are known as pass-through entities. That means the profits and losses of the business are passed through to the individual members and are reported on their personal tax returns. And on that note, I'd like you to return, so please subscribe if you haven't already, so that when more videos come out like this, you'll be up to date right away. And it would help me out a ton if you could click the like button so YouTube promotes this video. So let's break this down further by looking at the different types of LLC taxation types, with the understanding that nothing here is tax or legal advice, just helpful information for you to first check with your attorney and CPA. And give us a call at 1-800-COMPANY, that's 1-800-COMPANY, if you want to form an LLC. First up, we have the single member LLC. Now, as the name suggests, this is an LLC with only one member. In this case, the LLC is taxed as a sole proprietorship or disregarded entity, whereas the LLC can still provide lawsuit protection when the business is sued. From the tax perspective, it's a whole different bucket. That is, from the IRS's perspective, the LLC doesn't even exist as an entity separate from you for tax purposes. This means that the profits and losses from the business are reported on the owner's personal tax returns using a Schedule C for general business activity and or a Schedule E for rental income, and then you attach those schedules to your personal 1040 form. In other words, by default, single-member LLCs do not typically file their own tax returns. All of the income that they make are reported on the member's personal tax returns as if that member made the money in his or her own name. If the LLC has no employees, you simply use your Social Security number as its tax ID number. And once your LLC hires an outside employee other than you, you can use an SS4 form and apply for a tax ID number, which in this case we call an Employer Identification Number, or EIN. So for tax purposes, a single member LLC is just like being self-employed, where you report all of your income and deductions on the Schedule C of your personal tax returns as if the LLC doesn't exist, or Schedule E for rental income. And that's where you report the income and expenses of your business. Say your business makes $100,000. So whether you leave some or all of that $100,000 in the LLC's bank account or move some or all of that money to your personal bank account, it doesn't matter. You still pay taxes on the entire $100,000. Okay, next we have the multi-member LLC. That's an LLC with more than one member. In this case, the LLC is taxed as a partnership. Again, the profits and losses of the business are passed through to the individual members, and each member's share of the taxable income is reported on a K-1 form that your CPA prepares for you, that is in turn reported on your personal tax returns. So if you hold 50% of the membership interest in a multi-member LLC, and that LLC makes $100,000 in profit, this means that you'll file a Form 1065 with the IRS to report the income and expenses of your LLC. And then you receive a Schedule K-1, which shows your $50,000 share of the income and expenses. Now you'll attach that K-1 form to your tax returns, and then you'll report that $50,000 on the Schedule Schedule E attached to your 1040 form. And again, whether you keep some or all of that $50,000 in the company or write a check from the LLC's bank account and deposit that money all at once or throughout the year into your personal bank account, it doesn't matter. The company doesn't pay the taxes. You pay the taxes on the $50,000, whether it's distributed out of the company to you or not. Okay, so we just covered the single member LLC and the multi-member LLC. Again, we call these pass-through entities for taxation purposes because the tax responsibility flows through the LLCs as if the companies didn't exist. Okay, now let's talk about LLCs where the members want them to be taxed as S corporations. So that's tax method number 3 of the 4 tax types you can choose. Now, the S corporation type is an option that's available to LLCs, and it can provide some great tax benefits that we'll talk about. All members of an entity taxed as an S corporation must be U.S. citizens or legal residents, and you can have a maximum of 100 members. Now, to elect S corporation status, you file a 2553 form with the IRS, and you must file this form within the first 2 months and 15 days of the tax year in which you want to make this election. For most businesses, that's a calendar year, so it's due by March 15th of the year where you want to make the S election. So essentially, when an LLC elects to be taxed as an S corporation, it becomes a separate tax entity from its owners. Now, the LLC's profits and losses are still passed through to the individual members, but the IRS requires you to pay a member employee what they call a reasonable salary, which is subject to payroll taxes. As such, you'll need to file a payroll tax return and pay payroll taxes on any salary paid to members. Then the remaining profits are then distributed to the members as distributions. That's an important term, which are not subject to payroll taxes. Now, this can result in some tax savings as the members can potentially pay less in payroll taxes than they would if their LLCs were taxed as sole proprietorships or partnerships. So let's take that $50,000 of income again. Say your LLC is taxed as an S corporation and you pay yourself a $50,000 salary and a $50,000 distribution to shareholders. On the $50,000 salary portion, you'd pay 12.4% Social Security and 2.9% Medicare. And that adds up to a combined 15.3%, which we call the self-employment tax. Now, on $100,000 of income in an LLC tax as a sole proprietorship or partnership, you'd have to pay $15,300 in self-employment tax on that salary. However, with your LLC tax as an S corporation, in this example, you're only paying out half of the $100,000 as a salary, so you only pay $7,560 in self-employment taxes, which is half of that amount. The remaining $50,000 we pay out to you as a distribution to shareholders. So you write a check or several checks throughout the year from your LLC bank account for that remaining $50,000 and write distribution on the memo section of the check and deposit that into your personal bank account. So you say, hey, that's pretty cool. Why don't I pay all of it out as a distribution to shareholders and save the 15.3% on all of it? Well, remember, the IRS says you can't do that. If you work for the company and own it, you have to pay a salary that is reasonable for what you do for the company. Then you pay the rest as a distribution. LLCs taxed as S corporations are taxed like regular corporations taxed in this manner. This means you'll have to have your LLC form an 1120S form with the IRS to report the income and expenses of your business. You'll then take the salary portion of your income and report that on your 1040 form like you would any salary. And then each member of the LLC also receives a Schedule K1, which shows their share of the non-salary income and expenses. So on that portion of income, whether it's been paid out as a distribution to shareholders or retained by the company, you'll report that portion of your income on a Schedule E and attach it to your 1040 form, and that portion is self-employment tax-free. So I'll use a term that I used in college science class. I call an S corporation a semi-permeable membrane. So some of the taxes flow through to the members, but some of the self-employment taxes can be filtered out. Now, here's something super important. Most CPAs will tell you not to own real estate in an entity that is taxed as an S corporation. First, it can kill you tax-wise. That is, adding to or selling real estate from or liquidating creates a taxable event. Next, if you own real estate in an LLC taxed as an S corporation, you'd have to show many hours of labor that you put forth in your real estate venture before you could deduct your passive losses. Say you hire a management company, you flush your tax deduction down the toilet. So what's the point of having passive income if you have have to show that you had to labor and toil to work for that money. Then when you die and your children inherit the property, they'll get stuck with a massive tax bill when they inherit real estate that's in an S-corp. But if it was in an LLC taxed as a sole proprietorship or partnership, they receive that inheritance totally tax-free. And finally, you don't pay self-employment taxes on rental income anyway. So there's really no point to having an LLC taxed as an S-corp to own real estate. Okay, finally, tax method number 4, we have the LLCs that choose to be taxed as C corporations. Now, this is less common, but it can be a good option for some LLCs, particularly those that are looking to raise capital or go public. And it might also be an option if you don't own any other companies with outside employees, so a family-owned company, and somebody in the family has huge medical expenses. And that's because you can have an LLC taxed as a C corporation pay for the insurance and medical bills of the employees and their immediate family members and take it as a tax deduction. But the reason it doesn't work well if you have outside employees is that you'd have to provide the same benefit to all the employees of that company and any other company that you own. When an LLC elects to be taxed as a C corporation, it becomes a separate tax entity from its owners, like an S corporation. However, unlike an S corporation, the profits of the business are taxed at the corporate level. Distributions to shareholders of a C corporation are called dividends, and the dividends paid to the members are taxed at the individual level as well. And this can result in what is known as double taxation, which can be less tax efficient than other options. So instead of paying dividends, pay salaries to members, which are taxable to the members and tax deductible to the LLC. Now, an LLC taxed as a C corporation files an 1120 form on its own income and pays its own taxes. Then those who receive salaries from the LLC report that income on their own personal tax returns. Now, in order for the LLC to choose C corporation taxation, you must file the 8832 form, and an LLC cannot elect C corporation taxation any earlier than 75 days before the 8832 form is filed. And as your CPA will tell you, the C corporation type of taxation is the worst choice for owning rental real estate, so don't even think about it. So we call C corporation taxation an airtight container. That is, at the end of the tax year, whatever the company retains stays inside that box, and the company pays its own taxes on its retained earnings. So be sure to consult with a licensed tax professional. They can help you navigate the complexities of the tax code and ensure that you're taking advantage of all the available deductions and credits. Finally, LLCs are a popular type of business entity that provides limited liability protection to its members, and when it comes to taxation, the LLCs are pass-through entities by default, which means the profits and losses of the business are passed through to the individual members and reported on their personal tax returns. Otherwise, you'll have to file a 2553 form at the appropriate time to choose S election, or an 8832 form appropriately to choose a C election. And depending on the type of LLC taxation you choose, there are different tax filing requirements and options, including single-member LLCs, multi-member LLCs, LLCs taxed as S corporations, and LLCs taxed as C corporations. And it's important to keep accurate records and consult with a tax professional if you're unsure about how to file taxes for your LLC. I hope this video has helped you understand how LLCs are taxed and how to file taxes for your LLC. If you found this information helpful, be sure to give the video a thumbs up and subscribe to my channel to keep up to date on any new information that comes out. We'll see you next time. This is The Business Guy.